Q&A time. Hey everyone, and welcome back to the channel. Today we're doing Q&A for the month of July 2019. Now, there's a bunch of you out there scratching your head wondering what happened to Q&A for June 2019, and the truth of the matter is that my laptop actually broke down last week, and luckily I had a couple of videos queued up, so there was a couple of videos that you've seen that I had pre-recorded, but this is the first video that I'm producing with my laptop back. And my smartwatch as well broke down in the exact same week, so it was a horrible week for me, and I got sick. So that happened, so I wasn't able to record the June video in time, and now we're in July, so I just figured, let's just make this the July one, and why always be, chasing the other month? So that's what we're going to do today. We're just going to skip June and just forget about it and move on to July. But of course, if you have any questions for next week, then go ahead and leave them down below right now, and also leave a like if you want. I would appreciate it. But yeah, leave a comment, leave a question down below for next week. And of course, I always make that post on the community board that you want to check out, because I usually go through the post on the community board and get all of the questions from there. So make sure you're watching out for that, and make sure you're subscribed so that you can comment and leave a question there for next week. But let's get into the questions. So the first question we've got here is from Jani, and she asks, I consider myself a relatively smart person, that's good, but when I look back on a few industry events that have occurred in various companies over the years, I would not have been able to determine that they could rebound from such an event. How can we know when a company is going through a survivable event, and how can you tell when you understand a company well enough to own it? Thank you, Hamish. That's an excellent question, because that is essentially the crux, the core of investing. We're trying to find really great businesses, trying to find businesses that have that sustainable moat embedded in them, and they're run by management that is trustworthy and skillful at what they do. And then essentially, we're just waiting for some short-term event to send the stock price down so that we can buy into it. But of course, when the stock price does come down, as an investor, we need to look at the event and be able to identify whether or not that's a short-term event, 1-2 year horizon, whether it's an event that is going to be fixed, but is going to be fixed in a very long period of time, maybe 5-6 years, maybe it strings out for a long time. And then, of course, there's those events that completely destroy a business. So how do we distinguish between each of those? And there's no real easy cookie cutter answer that I can give you. But what I personally do is I like to look back and see if a similar event has happened in that industry in the past, and has it happened over and over again. And I'll give you an example of this. In the restaurant industry, every now and then, the restaurant industry experiences either food inflation or labor inflation, rising labor costs. And at the moment, the restaurant industry is facing, and quite a lot of businesses that have minimum wage employees are experiencing labor inflation. And the reason for that at the moment, in the US at least, is that many states are planning or have already raised their minimum wage. So as a result, minimum wages come up, and because many of these restaurants and other businesses that have minimum wage employees, they're going to have to pay more for those, and the prices increase. And this is an event that I hadn't heard of before, when the first time that it happened to one of the companies that I owned. So I looked into it, and I found out that this is something that happens with many businesses, and it's a normal part of the business cycle for labor costs to rise. And essentially what happens is labor costs rise, and even though companies may be producing more revenue, their profits may be staying the same or even going down because they have those increased costs. And as a result, Wall Street and the big funds that need to be performing every single quarter, they need to be owning stocks that are getting profitable and going up in the next quarter, in the next couple of months, they are going to sell those stocks, and they're just going to buy them back when the cycle comes back around, when the labor costs sort of level off and profits can start to grow again. And this is a short-term problem because it happens over and over again, and costs rise, profits shrink, and then the labor costs or the food costs level out or start to go back down, and then profits can start to rise again. So the the best thing I could say for you is just to see if the same problem has happened over and over again in the past, maybe in different businesses in the industry. Other than that, it's just going to come down to your understanding of the industry. And this is going to develop over time. Sometimes you might make an investment and you might think this is a short-term problem, and you'll make the investment and it will turn out that you were wrong and you learn next time. Or maybe in another situation, you see a short-term problem and you think that's a long-term problem, I'm going to stay away. And then it turns out that it gets fixed. And for the next time, you can know that when that event happens, it's a good time to invest. So those are the two things that I would say for you. So the next question we had here was from Khaled. Hi, Hamish. Majority, if not all, of businesses that I'm interested in are trading at an all-time high, not surprisingly. However, my calculations and 50% margin of safety, I'm getting the best value for these businesses were around the 2008-2009 crash period. Is that coincidental or is that true? No, that's true. Around that time, valuations across the board were a lot lower. Valuations generally in that period, I think they got to about 15 times earnings. And at the moment, you can, for most companies, the average I believe at the moment is about 25 times earnings. And in many companies, it's a lot higher. You see companies trading at 35, 40 PEs, price to earnings ratios, pretty regularly in this market. And the result of that is that you're paying a lot more for the same earnings power. And that doesn't mean you can't invest. A lot of people get angry at me on here because I'm so conservative and that I talk about conservative numbers. But in no means am I saying you need to wait for a 22% return or for even a 15% return. But the price you pay directly impacts what return you're going to make. If you have the discipline to wait until there's those times when stocks are really, really cheap, and you can invest in those times. And it doesn't mean it's just in a recession. It also is when an industry is going through a poor period, like the restaurant example I just spoke about. When there's rising labor costs, the restaurant market is going to be suppressed, and the multiples, the price that you pay compared to their earnings over the long term, will be lower than average, and you can start to invest there. So is it a coincidence? No. That's just the reality of the stock market. When there's a lot of fear, prices are lower relative to companies' future earnings. The next question we've got here is from Ryan, and he asks, how do you get yourself so enthusiastic about the stock market? I want to earn more money, and I know this is definitely a great way to make more money in the long term. I have invested in stocks and made bad decisions based on not putting in the time to read annual reports. I have read half of Phil Town's books, but I'm lacking the motivation to keep going with it. Any suggestions on how I can get myself more enthusiastic about this process? This is a tough one because for many people, crunching the numbers, reading the annual reports, it's just not fun. And I completely understand. It's not the most exciting thing to read about how a business, sources their products or something like that. I completely understand. The best thing I would say is, there's a couple of things. The first thing I would say is really try and find businesses that you're really interested in. And this can be more difficult than it sounds. A lot of people say this and then they try and find them and they realize wow, it's actually hard to find businesses that I'm really, really passionate about. But I would just look to the products and services that you use in your life, and not even just the products and services that you use. Companies, what do you do in your spare time? What do you enjoy doing? And find what that is. Like for me personally, I enjoy making these YouTube videos and I enjoy pretty much spending my time building my business. And so that for that reason, I have a passion for looking into how Facebook ads are working and how their ad system works and how Google's ad system works. That's a passion for me. Another one, I'm quite interested in the restaurant industry. Funnily enough, I'm certainly not going to be running a restaurant in the future, but I have worked at a few restaurants in the past. So I don't know, it's just an interest to me, and I find it, because it's quite a simple business model, I find it quite fascinating how the mechanics of that industry work. The other thing that I will say is another way to motivate yourself is just to set a time each day or each week, maybe every second day, that you're going to sit down and you're going to do the work. And once you have that routine going where maybe every evening for half an hour even, or 20 minutes even, you just decide, I'm going to read a little bit more of this annual report, or today I'm going to jump on Hamish's spreadsheet and enter in the numbers for this company. And when you do it every single day, it'll become more of a habit for you, and it'll be less sort of, you'll need less willpower to go and do it. And for that reason, it might motivate you a little bit more to do it that way. But yeah, the best way, I think, just try very hard to find companies that you can really get behind, that you actually have a passion for. That'll be the best way that you're going to invest over the long term for sure. The next question we've got here is from Christopher. He asks, what stock platform do you use to buy your stocks, and how does it compare to others? I'm Australian, so I just use CommSec, which is through Commonwealth Bank. And I've never really given this much consideration. I know a lot of people sort of stress over and they just do a ton of research about finding the cheapest broker and all of this. For me personally, it just came down to a couple of things. I wanted a really trustworthy bank to be trading through, because I want to make sure, I don't really care about having the cheapest brokerage. I want to know that my money is safe and that the stock certificates that are held by the bank, because we don't hold anything. We trust the bank to hold on to all of that data for us. I just want my money to be safe. And for that reason, I just picked one of the 4 major banks. Really, it came down to between NAB and Commonwealth, because those are the two that offer reasonable international trading. I think NABS is maybe $15 per trade, US dollars, and CommBank might be $20 US, I think. But I went with CommBank because I just bank with them. There's no real reason behind that. And in terms of the brokerage, it really doesn't matter to me, because when I'm long-term investing, I'm lump sum investing. So I'm investing enough that my cost is easily less than 0.5%. It's usually less than 0.1% when I'm making an investment. And I don't trade in and out of stocks, so I don't really care about that. And the platform's fine. I don't use any of the data on the platform. So I'm probably not the best person to answer that question, but in terms of what I do personally, I really don't worry about it at all. I don't think it's that important. The next question we've got here is, hey Hamish, could you talk a little bit about how you acquired your knowledge on finance and stock market investing? So from a couple of different places. First of all, I studied finance at university in Melbourne, so that kind of was a main contributor to the core of my knowledge, I guess, in terms of doing cash flow analysis and accounting principles. That was probably the best thing that could have happened to me in terms of learning accounting, because I hate accounting. I don't know if there's many people out there, I'm sorry if you're an accountant, but I don't know if there's many people out there who can actually love accounting. And I certainly I would have struggled at least to learn all of the intricacies of accounting on my own. But luckily I was studying finance, so I was kind of forced to learn accounting, and that's helped me out a ton in the stock market. Just understanding the little, the little rules and little things that you sort of might not understand, that the average person might not understand on an income statement or a balance sheet. But in terms of learning how to invest, it's really just come from my personal research and learning from great investors. So Benjamin Graham, one of the biggest people that I look up to and that I learned from reading The Intelligent Investor and Security Analysis. Warren Buffett, reading his letters to the shareholders. While I think a lot of people think that Warren Buffett's information is more sort of too general and it's too broad, but the principles that he talks about are so fundamental, and it took me a little while to figure this out, but what he's saying is all that matters. Like it sounds like, yeah, okay, Warren, don't lose money, but what does that really mean? And really, as long as you have these key principles in front of you and you have a core investing process, which is the same when you're looking at Warren Buffett or you're listening to Phil Town, you're talking about just understand the business, invest in what you know, investing in companies that are really good in their industry. Like they're either top 3 in their industry. Usually they have that competitive advantage. Management is amazing within the company, and you're buying them at the right price. Those are just the core pillars. And really, I always boil it down just to 2 questions, and I always I'm trying to answer these 2 questions. Is it a great business? And how much cash will it produce for me? That's it. Is it good? Meaning, how safe are those cash flows? And then what are the cash flows? And then I can work out how much to pay. So just books, YouTube a little bit, and my university degree. The next question we've got here is, you live in Australia, I assume. Have you seen any poisonous snakes out in the wild? No, I've never seen a snake. And yeah, I live fairly close to the city, so I'm not out in the countryside where you would probably more likely see poisonous snakes. But actually, that's not true. I have seen one poisonous snake when I was very, very young. I remember there was one. But no, not really, unfortunately. Sorry to disappoint you there, but there's not just snakes rolling around on the floor everywhere in the city, in Australia, unfortunately. The next question we have here is, what are the most important things that you look for when listening to earnings calls? So earnings calls. Okay, so a couple of things. I'm looking to listen for management's integrity. So I'm looking to see how management talks about their results. So usually in the earnings call or the conference call, they'll have a section where management will just talk about their results, and then there'll be a Q&A. The first bit, I like to hear how they talk about their results, particularly if there's something that's obviously gone wrong in the quarter. If they don't bring that up, then that's a real concern for me. They need to address that, and it needs to be in the forefront of their mind, because it's obviously in the forefront of shareholders. And then I'm listening to the questions, and in the questions, you get so much information about what is the short-term problems or successes of the business, because analysts only give a crap about what's happening in the next couple of quarters. They rarely ask questions like, what's the long-term vision for the company? They're asking about, well, your margins went down 2% this quarter. What happened there? Like, they're asking short-term garbage, and the short-term garbage is important. It's because you can use it to identify whether or not there's a short-term problem in the company or a long-term problem in the company. And listening to how the management answers those questions can be super useful. If management can't answer a certain question, or they're dodging a question consistently, then that could be a bad sign that management isn't going to be honest with shareholders. So that's actually all the questions we had time for today. So thanks everyone who left a question. And again, of course, if you have a question, leave it down below, and make sure you're subscribed so that you see that post on the community board in about a month's time for next month's video. But yeah, leave a like if you enjoyed it, and I'll look forward to talking with you guys with some more questions in next month's video. So have a good day, guys, and I'll see you later.